Now, the pendulum of sentiment has been swinging wildly this year, bringing lots of volatility for traders and much uncertainty for long-term investors. The sharp sell-off we saw in global markets in January swung sentiment to one extreme of the scale, followed by a sharp recovery fueled by a shift in sentiment to the other extreme of the scale. So emerging markets have been the major beneficiaries of the last 9 months rally on global market conditions. But the big question is, can this continue? And will we see them continuing to ride this bull market activity that we see? We'll be joined by a wonderful guest for our panel discussion, Petri Redelinghuys, founder of Herenya Capital Advisors and a familiar face to the channel, Tumisho, Grater, economic strategist at Novare Actuaries and Consultants. Good to have you both with us today, and thank you so much for making time.
Thank you.
Petri, let's start with you by getting perspective on the volatility in the global market conditions. Is it all to do with what we've seen with central banks, especially in the last 12 months?
Well, for the most part, yes. I think it's a combination between central bank policy as well as what's been happening in the commodity prices, particularly in oil. So at the beginning of the year, it seemed as if the world was going to end, and I think, at the time I was even very vocal about the fact that the house of cards was about to come down. However, since then we have seen further support from central banks throughout the world, essentially throughout Europe and America, as well as Japan and China, coming to the party, so to say, to try and support markets by further, making further sort of monetary policy changes that is accommodative to current conditions, or to try and boost the market, essentially. Also, we have started seeing coordinated action from OPEC, and now, at the time that the story was written, we didn't know that OPEC was going to cut, but now that they have, it starts looking as if, most of the powers within the OPEC region is starting to feel the pinch a little bit, and they're starting to work together to finally bring an end to not low oil prices. I mean, I don't think it'll go up to $150 a barrel at any point again, but, I think that the lower for longer oil price argument is probably a thing of the past for now. So it seems that we've got these two dual factors. We've got a number of factors that are pushing money away from developed markets into emerging markets, being low interest rates or negative yields on a lot of the investments that you get there, as well as this quantitative easing programs where there's just all this extra money and liquidity coming in, pushing markets into emerging, or pushing funds into emerging markets. And the other end of the scale, we've got emerging markets that are offering really, really high yield and some good value for money in some of the investments, particularly within the resource space.
Very true.
So that's, I think, what's happening, and I think that emerging markets will probably continue to benefit from that for the next maybe 18 months.
I want to pick up on what you mentioned regarding the stimulus from central banks, and to me that leads me to a column that you wrote in FinWeek this month, where you mentioned that this might cause certain disruptions from a global point of view. Elaborate further as to whether or not these policies being implemented by central bankers are actually working or not.
Yeah, now, I think that's a big question. Are they working, or aren't they really working? And I think if we look at monetary stimulus and what it's done for the financial sector, we did see central banks step into the fold during the 2008-2009 financial crisis, and that certainly helped. And although we are still in this particular environment where we are still in recovery, monetary policy has been used to such a large extent that it does have certain limitations. So I think we've all seen the headlines over the past 2 days or so regarding Deutsche Bank and the health of the European markets. Yes, or the financial stocks, to be more specific. Yes, we do understand that there are issues there, but the fact that we've been sitting with interest rates that have been sitting so low essentially has led to a situation where the costs have certainly outweighed the benefits. So now we've got a position where these institutions are actually not able to make money because we are sitting with such low interest rates. So now comes a point where we have to have fiscal policy playing together with monetary policy too.
A twofold question, and either of you can respond to this then. On the back of these dynamics that we see from central bankers, it doesn't necessarily correlate well with the economic data that we see from a global perspective, as we've seen the IMF cutting back on global growth rate expectations. And secondly, what this means for the equities market. Does this mean that this bull can continue running for that much longer?
Well, okay, so I'm going to revert to good old-fashioned technical analysis at this point and say that, part of the reason that caused a lot of fear in me at the beginning of the year and the later part of last year was the fact that, we've seen the US markets as well as our market. Our market has not broken the consolidation. The US has, though. So there was about a 2-year consolidation where the market had run up really strongly from 2009, and then started sort of just drifting sideways for an almost 2-year period. That consolidation has now broken out towards the upside. So we broke out, we ran, we made new highs. It's now come back. It's tested the breakout level, and it appears to be bouncing. Okay, I mean Friday night, last night, Thursday night was a bit of a hairy one, but it seems as if the bounce is back on today. So I think that this was a retest of the breakout, and if good old-fashioned charting techniques tell you that after the breakout, there's an initial break, there's a retest, and then a continuation pattern, which should be another 9 months or so of upside at the very least. So from a technical standpoint, I think that would be one argument to say that yes, equity markets may have some way to go.
I think I'm going to be looking at it from a perspective of, are we going to still see this hunger for risky assets? And I think we've seen what's happened with the rand. We certainly have been seeing a lot of appetite for these types of risky assets, and I think the global theme that's been playing out has been lower growth. So you're talking about the US. We had GDP data that was released yesterday, a little bit softer. Yes, it was revised to the upside, but really if you look at the first half of the year, we are still looking at a weaker US. So you get durable goods numbers that come out, and it still throws a bit of a spanner in the works about the sustainability of this recovery. So we do need to be looking at the US to see if we could be seeing a recovery there. Brexit, that's also going to be a very, very big theme coming through from in terms of the EU, that Article 50 hasn't been triggered yet. There's going to be a lot of political risk that's still coming through with regards to German elections, French elections, so that's one thing to watch out for. And of course China, that's we can't forget that particular factor, because you've got the cyclicality of its particular property market, and of course this will also be it will impact what happens with emerging markets, and whether or not we will still see investors wanting to plow their money into these particular assets.
Yeah, and that's the big question, because we know once the Fed as well might come through with interest rate hikes in December, there's a lot of panic and concern that we might see this capital flight again from emerging markets. But given that it's normalization of rates in the US, should we be nervous as investors about our exposure to EMs?
I think that I just want to pick up on a point that Tumi made. So I think that even though there are headwinds, especially within China, if you look at their debt to GDP ratio, it's almost 300%. I mean, it's ridiculous. But as long as we do see quantitative easing programs and low interest rates from the US and quantitative easing programs from Europe, I think that the market's running up on drugs, on the stimulus, and it's probably not going to stop. So I completely agree that we are building a giant asset bubble, but I don't see it happening. So, I don't see it popping until the interest rates in the US start increasing, not by 25 basis points in one increment over 12 months, but increasing at every meeting and sharper increments. So when they start increasing interest rates really sharply, really quickly, that's when I think the party will end. When that's going to be, I mean, I don't know. Nobody can predict that. But, come an interest rate hike by the end of the year, I don't know what the chances are, to be honest with you. I think it's a little unlikely. I think if they do put interest rates up, we'll probably see a similar reaction than what we did in the January of this year, where interest rates went up in December, and then we saw a very sharp sell-off followed by a recovery going, well, it's actually not that bad, So the real concern for me would be really when the US starts putting interest rates, or the Fed starts putting up interest rates in quick succession over a short period of time. Then I think we are in trouble. Until then, I think it's business as usual.
The party's still on.
Party's still on for the markets. Well, we'll have to leave it there for today, and hopefully investors will be able to seek out opportunities, which we'll leave off very briefly. Thank you so much to you both for joining us for this panel discussion. We could probably go on for hours on end with regard to these dynamics, but unfortunately time is limited on the show. But a big thank you to Petri Redelinghuys, who's the founder of Herenya Capital Advisors, and Tumisho, Grater, economic strategist at Novare Actuaries and Consultants.